ESG screening is a structured investment approach that applies environmental, social, and governance criteria to identify, include, exclude, or prioritize securities within an investment universe. While screening originated in equity investing, it is now widely applied across fixed income, equities, and alternative investments. The objective is to align portfolios with sustainability goals, manage ESG-related risks, satisfy regulatory or client requirements, and improve long-term investment outcomes. Effective ESG screening requires understanding how sustainability issues affect different asset classes and subsectors. Because ownership structures, risk characteristics, and valuation methods differ among asset classes, screening methodologies must be adapted to reflect the unique features of each investment category. In equity investing, ESG screening is commonly applied through negative, positive, norms-based, and best-in-class approaches. Negative screening excludes companies involved in activities such as tobacco, controversial weapons, gambling, thermal coal, or significant ESG controversies. Positive and best-in-class screening identify companies demonstrating superior ESG performance relative to industry peers. Norms-based screening evaluates compliance with international standards relating to human rights, labor practices, environmental stewardship, and anti-corruption principles. Equity investors often apply ESG ratings, proprietary scorecards, and sustainability metrics to compare companies across sectors. Screening helps investors manage ESG risks while directing capital toward organizations demonstrating stronger sustainability performance and governance practices. Within fixed income markets, ESG screening can be applied to both corporate and sovereign issuers. Corporate bond screening generally follows principles similar to equity screening by evaluating issuer-level ESG performance, governance quality, environmental risks, and social practices. Investors may exclude issuers with poor ESG records or favor those demonstrating strong sustainability management. Sovereign bond screening requires a different approach because countries are assessed rather than corporations. Investors evaluate factors such as governance quality, political stability, corruption control, environmental vulnerability, human development, education, healthcare systems, and social conditions. ESG screening helps identify sovereign issuers that may face elevated credit, political, or sustainability-related risks affecting long-term repayment capacity. For corporate fixed income subsectors, screening often focuses on factors that directly influence credit quality and default risk. Environmental liabilities, regulatory exposures, governance weaknesses, labor disputes, and reputational controversies may affect an issuer's ability to meet financial obligations. Investors may apply exclusionary screens to issuers involved in controversial activities or use positive screening to identify companies with strong ESG risk management practices. Green bonds, sustainability-linked bonds, and social bonds may also be screened according to project eligibility criteria and sustainability objectives. The primary emphasis in fixed income screening is often downside risk protection rather than maximizing growth opportunities. In alternative investments, ESG screening approaches vary according to the specific asset class. Private equity investors frequently screen target companies for governance quality, environmental risks, labor practices, and regulatory compliance before acquisition. Real estate investors may apply screens related to energy efficiency, carbon emissions, environmental certifications, tenant well-being, and climate resilience. Infrastructure investors often evaluate environmental impact, stakeholder relationships, governance structures, and long-term sustainability considerations. Hedge funds and other alternative strategies may integrate ESG criteria through proprietary risk frameworks or thematic investment approaches. Because alternative assets often involve direct ownership and longer investment horizons, ESG screening can play a particularly important role in due diligence and risk assessment. Applying ESG screens across asset classes requires balancing sustainability objectives with diversification, return expectations, and investment constraints. While screening can help align portfolios with ESG goals and reduce exposure to certain risks, it may also narrow the investment universe and introduce sector or geographic biases. Therefore, investors often combine screening with broader ESG integration, stewardship, engagement, and active ownership strategies. Effective screening frameworks consider the unique characteristics of equities, fixed income, and alternative investments while focusing on financially material ESG factors. By adapting screening methodologies to each asset class and subsector, investors can improve risk management, support sustainability objectives, and enhance long-term portfolio resilience.